Welcome back. North American stock markets, as we've seen, are trading modestly higher so far this morning. In the early minutes of trading, the TSX Composite, the Dow Jones Industrial Average, and the S&P 500 all well into positive territory, a little less so for the Dow. This comes after a softer inflation reading last week. For more on the markets, as we settle into the heart of earnings season, we're joined by Ryan Bushell. He's president and portfolio manager at Newhaven Asset Management. Thank you, first of all, for joining us.
Thanks for having me.
What's your take so far on earnings season? We're about halfway through here, and we're starting now to get into the heart of Canadian earnings season.
Yeah, so earnings season, again, a little bit stronger than I think was anticipated earlier this year. I continue to worry a little bit more about the back half of the year, but so far so good. And we're going to really see, Apple this week, the largest company in the world. I'm interested to see there, if there's signs of just strain on the consumer, both domestically and globally. I think it should show up in Apple's results, and that's really going to be a good bellwether to watch going forward, I think, given the balance they have of consumer products and a technology background.
What about Shopify? Would the same apply there, a bellwether?
Certainly for the Canadian market, a little different given their size. Obviously, like they're a big company for Canada, but as Cash mentioned earlier, 3.5% of global e-commerce, not that large.
Right.
Whereas Apple, just the largest company in the world, and really, it's a technology company, yes, but it's also a consumer products company, and it's a high-end consumer products company. So I think the price is paid for those types of goods. We're going to see how the consumer is doing. And it's still taking time for these interest rate increases to kind of lap through consumer spending.
Right.
I read a good piece the other day that said, typically monetary policy is reflected 4 to 6 quarters later. So if you think about 4 quarters ago, we were still dealing with about 2% interest rates. It takes time for those interest rate increases to hit everybody's consumer loan or mortgage, et cetera. So we continue to be pretty cautious as we look forward here as we start to lap, 5% plus rates about this time next year.
I believe you believe that the markets are a bit too ebullient about the low inflation print that we got last week, correct?
Yeah, I think that obviously the market is looking for that next decline in interest rates to get us back to levels that are more palatable. I don't think anyone believes that if rates stay at 5+% and the longer term interest rates start to reflect that, meaning the inversion actually came out of the yield curve when we had a positively sloped yield curve where 10-year rates were, say, 6-7%. I don't think anyone thinks with this much debt in the system that markets, consumers, businesses can deal with that. So the market's ebullience is more related to, okay, when are rates going to come back down? And because over the last 10 to 15 years, anytime that's happened, it's been a very positive signal for markets. So, I think markets are a little bit too anticipatory when it comes to that. We've seen those rate cuts that were priced in for this year come out of the market. I think they come out of the market at least for the first half of next year as well, given the ongoing strength in core inflation. And then when you look at headline inflation, we've now got oil prices back up over $80, and that was a big reason for the headline declines in June.
What about the soft landing? Many investors seem to be more and more confident that the U.S. economy will avoid a significant recession.
Yeah, this is the several trillion-dollar question, I think, is, will we get enough economic growth to sustain us through these tightening measures when it comes to monetary policy? So we still have pretty expansive fiscal policy. The Inflation Reduction Act continues to work its way through the system. These things get announced, and it's a big announcement of X amount of $1 billion, but then it gets spent as the years go by, and that's still providing some boost to the economy, significant boost, as is the pandemic stimulus that is still excess savings in consumer accounts, but also dwindling out, right? So the question is, do we have enough underlying economic strength to get through the interest rate increases? And my view has always been, we will either have high interest rates and a soft landing or low interest rates and a hard landing, but not both. We were not going to get lower interest rates and a soft landing. I do not think that that's possible. So the question is, do you wait? And that's what we've been doing. We're happy to collect dividends in the 5 to 6% range, cash in the 4 to 5% range, and just see what happens here. Because for us and our clients, what's really important is not so much catching these shorter-term upside events, it's avoiding the big losses of capital that come in the downside events. And we saw that last year with certain companies if you bought them towards the tops. I think this year, these types of levels are very dangerous again. If you're buying Shopify today or even Google or Amazon today, we saw the types of drops that happened last year, and you don't have any dividend to sustain you until they come back.
The tech rally is overdone then, you believe?
I believe it's dangerous. What I keep saying to clients is, if we really are in a new paradigm where tech stocks are going to consistently trade at extremely high valuations, even though interest rates are high valuations made a little more sense when you had a 10-year rate less than 2%. A 10-year rate less than 2% equates to a PE of 50 plus for, the bond income you're getting. Basically, you're getting, $1 or $2 of income on $100 of capital. In a world where you're now seeing a 4% 10-year bond, and I think going higher, at least in the short term, that number's closer to 20. And so the market should be, cognizant of that, but it hasn't been. So again, I think that the gap widens out in terms of, the range of outcomes you can have on the downside. And that's where, again, we're trying to protect clients' capital on a multi-decade basis, not so much worrying about year to year. Are we keeping up? Are we not keeping up?
That's Ryan Bushell.